Good evening to all our participants present for the webinar. I, Faraz Vatwania, on behalf of Devex, welcome you all to the event ABC of Fundraising. Devex in past has organized numerous webinars and events to stay connected with the community. So before moving forward, I would request everyone to kindly switch off their microphones and cameras for a better experience. The chat section is disabled for now and will be enabled after 15 minutes. So I request everyone to kindly share their questions in the chat window. The best of the questions will be provided a chance to interact live with our panelists out here. Fundraising, a word that brings an adrenaline rush to every founder. With this series of webinars, we have come up with a webinar series called ABC of Fundraising. In the first part, that is today, we typically will be focusing upon the options available for the fundraising and its structural requirements. The second part will focus upon decoding the term sheet and essentials of a startup pitch deck, while the third part will focus upon the exit options that are required. Moving ahead, I would like to now introduce our esteemed panelist for the day, Mr. Sheth. Mr. Sheth is the co-founder at legalwiz.in. He is an entrepreneur with excellent business acumen. He has years of business experience into business analytics and strategy, ranging across companies of varied scales, industries, geographies, and culture. He is best known for his people skills and team play, and also for his can-do attitude, analytics, problem-solving ability, and business acumen. The second panelist of the day we have is Mr. Druman Patel, who is a partner at Manubhai and Shah LLP. He is an enthusiastic young partner with a demonstrated history of working in accounting industry. A strong entrepreneurship professional who graduated from the Institute of Chartered Accountants of India. He is skilled in process engineering, problem solving, financial analysis, leadership, and delegation. To begin with, I would first of all like to request Mr. Shrijay to share a bit about LegalWiz, what they do at LegalWiz, and then go ahead with this part of webinar. Shrijay, over to you. Thank you.
Absolutely. Thank you so much, Faraz. And should I just also start sharing my screen so everybody gets to the presentation? All right. Everyone, thank you for having me over here. My name is Shrijay, and I run a company called legalwiz.in. LegalWiz provides business professional services. It is a tech-driven portal which provides services on starting and managing businesses. And we focus on small businesses, startups, and MSMEs as a sector. So anything that is required in terms of registering a business all the way to intellectual property protection, legal compliances, document drafting, accounting, GST, and other government registrations, you can find us to be a one-stop solution for a lot of services. As we speak today, roughly around 1 out of 200 companies, which is 0.5% of total India, that gets incorporated as a private limited company, happens to be a LegalWiz customer. So we work at a scale, but at the same time, we are extremely customer centric, and we try to bridge the gap, which is a slogan that we carry called simple, affordable, and transparent. So we want to bring a lot of simplicity, affordability, and transparency in the trade, which we thought to be a very valid problem statement that we could provide a lot of value through a technology enablement. So again, this is what LegalWiz is. Particularly, I've been in legal tech for quite some years. It has been roughly around 12 good years of career that I've been associated with legal tech as a specific, and e-commerce or services e-commerce in specific. First half of my career spanned working with larger legal tech organizations back in the US, and then I moved to India in 2013 and 2016. We actually launched the portal LegalWiz, and ever since I've been driving this portal to be thousands of customers strong in servicing across pan India and abroad. Again, thank you so much for having me over here, and I'll very quickly jump to the subject that I've been given. Just making sure my screen shared with everybody. Faraz, can you?
Yes, the screen share works fine.
Okay,
Kindly
great.
go ahead.
All right. So the first thing first. Sorry. Yep.
Shrijay, just to
Absolutely.
right, just stopping you here. Before starting up with the presentation, I mean, if you could please share with the audience as to what points you are covering in a nutshell, so that it becomes easier for them to understand what you are trying to deliver today.
Absolutely. So, so me and Druman are going to be, the co-panelist over here. While I would try to cover, why do you need funding? Particularly, what are the funding options that are available to a startup in a growing business? Amongst different options that have been available, with us. How should you opt for the one that is best for you, and then eventually diving into the equity based funding. So if you are going with equity based funding, may it be through friends and family or series A, or through a VC, or through an angel investor, then what are your options available and how do you prepare yourself for that. So I'll be talking about that, and then I think Druman Bhai is going to take over, and he's going to talk more about the debt funding and other options available, along with how to structure that. We are going to keep it a little more high level at this point of time, and then obviously, as Faraz mentioned, this is going to be a regular series. So as we move along to the next week, we are going to take a deeper dive into some of the very specifics of, let's say, the term sheet and the how to build a pitch deck and those sort of things. So you can expect those nitty-gritties to come in the next week's session when we move forward with the series. Are we all on board with that?
Cool. Sounds good to me, Shrijay. Kindly go ahead with your presentation. Thank you.
Okay, great. Perfect. So the first thing first, and we all know that funding is very important, right? Every startup needs, or every business in general needs funds to operate, maybe to pay off employees, maybe to expand, maybe build new products and whatnot. So there is really no alternative to having funds in place. Right, but one thing that we need to assess, the first thing that needs to be assessed is why do we need the funds, right? And when we assess that with more clarity, we actually can come to a conclusion, what sort of funding do we need to chase for, right? So the first thing first is, a lot of people confuse short-term liquidity crunch with a long-term funding requirement, right? While there are a lot of different uh, tactics that you can, or the pivotal moves that you can bring to your business to create short-term liquidity. And one of the good examples is a few announcements that government made a couple of days back, which was more towards creating liquidity in the markets rather than providing a lot of new funds in terms of newly printed notes, or crediting everybody's account with 15,000 rupees a month. Government took some measures to create a short-term liquidity. For example, delaying the loan payments or deferring the interest payment, or creating some flexibilities with the PF. So in your own business, you can also look at what is exactly required. And if you need a short-term liquidity, that does not mean that you want to bring funding in. You rather want to make some tactical change in your business and operations to meet with the liquidity requirements. Now that is a topic for some other day, but let's suppose you are in need of funding, and which is your long-term requirement, right? Then what would you want to have is, you would want to assess for what reason do you need funding, right? Whether it is whether it is to fuel growth, it is to build new products, technology, what it is. And more importantly, right, for every startup, because this is a very common misconception, that is why I want to kind of address this at this podium, is funding is just a milestone. A lot of people, especially new graduate students and people who are very enthusiastic about their startup journey, funding becomes an ultimate goal, or something that they're in so much of an awe of, right? So at this point of time, we do want to clarify that it is just a milestone, absolutely a major milestone, right? And there is no substitute to money, but at the same time, treat that as a milestone and a resource opportunity that you can build your future growth upon. Right. So while you want to make sure that what you pick in the fund as a funding option, maybe at equity or debt or other things, right, you want to consider certain things, what it is that you need it for, right? So what is the risk associated with each particular sort of format, and also with your business, right? If let's say there is abundance of risk in your business and you really think that the money is going to uh, uh, it's either going to skyrocket or it is going to land zero, then creating a lot of debt on your personal resources might not be a best idea, and you might need somebody who believes in your vision and provides you an equity funding which you might not want to return back in future, but you want to return back in terms of ROI. Right. So what is the risk associated? What are the cost of funding? So typically debt funding comes at a lower cost, and we'll discuss more about it, how it is structured and whatnot. But what is the cost at which you are raising funds, and whether your operations actually allow you to sustain that cost or not? Right. What are the additional benefits that are available? So when you take money from bank, it doesn't necessarily come with a lot of strategic alliances or strategic partnership or inputs in the business and so on and so forth. While you go for an equity funding, those options are available. So whether you need that or not also becomes a defining factor, whether you want to go for a debt based funding or an equity based funding sort of thing. Right, the business risk, the expected scale that is available. So once you get a funder onboarded, and with the involvement, not just the money, but money plus skill set plus network and whatever, what is the scale that you expect out of that, right? Is it really going to help you? So if you are weighing two options, right, option A being a pure debt funding where you get money against X percentage of interest, versus option B, you probably get money at certain dilution of equity, but also at the same time some speciality or the strategic involvement of that funder, which brings your business to scale very quickly, right? So you would want to weigh those options of how much more time would you think you would take on your own to get from point A to point B, versus having some sort of partner who already has that expertise, and how short of a time it can take you from point A to point B. Right, the cash flow position is very, very important. A lot of times, um, when companies' cash flow positions are very bad, then obviously the funding options become very tricky, and at that point of time, raising an equity becomes much more expensive, because you have to trade a lot more equity to get it. The other person also probably takes an advantage of the situation, and say that anyways, if the cash flow does not work for you, then you are going to dry out of funding and eventually close your business. So in that case, an equity based funding becomes very expensive, because you might just lose a lot of equity against that funds, right? And the other thing is, what is the opportunity cost? So if you did not have this funding, or if you don't go with the funding round, then what is the opportunity that you are losing? Versus if you get this, right, then what are the opportunities that you open up for yourself? So a lot of times what happens is, people become very possessive about their equity. But one thing that we would want to make sure that we understand is, if you have 10% stake in a 1000 rupee company, that gets you 100 rupees. And if you have 100% stake in a 50 rupee company, that is still a 50 rupee note in your hand, right? And so at times you have to weigh the options that you have available, and see how much of a scale can you get out of getting into this particular arrangement. So let's move on, and see what are the funding options that are available. So a lot of times when people talk about funding, people only talk about equity, right? And I have to dilute my equity, for which I will get X amount of money. Sometimes it also remains true for startups, because if they don't have assets to pledge, or they don't have like real tangible assets, at times it becomes a little difficult to sort of raise debt. But again, Druman Bhai is going to talk about it in detail, and how some of the successful debt structurings could have been done. um, but talking about other options that are available, so bootstrap your business, one option. You bring your own money, you run your business successfully, everything that you earn remains yours. Very simple, right? crowdfunding options or pre-sale your products. A lot of times what happens is these are very innovative options that people don't really look into a lot. But there are definitely some good websites if you are especially a product driven company to actually pre-book your money and raise some short-term working capital out of it, right? So Indiegogo, being one of the prominent ones in India and overseas. There are definitely some other ones like Product Hunt and whatnot, where you can list your products or services and you can actually get some money as a pre-booking of your product. So if you are an innovative product and especially a tangible product which can be delivered, I would definitely recommend everybody using this source of funds. Seed funding, friends and family, or angel rounds. This is typically equity based funding, which happens at a very initial stage of the business. So if you guys are businesses which are pre-revenue, which are barely started, something that still is kind of making a mark in the in the market, and still in the proof of concept stage, I think seed funding of friends and family is a good way to go about it. Obviously, an angel is somebody who is not within friends and family but acts like a friends and family. So in angel funding also, you can expect things move along the similar way. One of the major downsides that you would probably see in these sort of fundings, especially an angel funding, is because the business is at much higher risk at this point of time. Definitely the funder also has to have a lot of confidence in the business. More importantly, also they would have more expectation of ROI from the business. And so at times your angel funding rounds are typically the most costliest rounds that you would see in terms of raising equity based funding. So a lot of times people end up giving away as much as 25 or 30%, which is definitely a higher side of it. But we have seen people giving up that much as well. So eventually when you lead to a pre-series A or series A, series B, you as founders or co-founders actually very quickly start losing control over the company. So something that you would want to consider at that point of time. Venture capital definitely becomes available at a little more mature stage of the business, when you have some sort of traction numbers, where you have already, typically when VC firms become interested in a company in two different cases that I've seen. One is where you already have some sort of traction or some sort of revenues to back up or claim your success. Or second is you come in the business with a lot of pre-built authority, which is probably your own profile, your co-founder's profile, the team that you have in place, right? So if the success is almost assured at that point of time, probably a lot of VCs kind of look at this option, for investing in startups. You would see a lot of VC funding coming in larger companies like, Flipkart or Uber or, Zomatos of the world. And typically that comes when you have certain amount of traction that is already come in. Apart from that, ecosystem players is something that I would very critically look at, because they not only provide you an ecosystem to thrive and survive, they also provide you connections and ecosystem to raise further round of funds. Typically they become your first funders in the project. So a lot of incubators, accelerators. I know Devex already does that, with their own accelerator program. So if you are at a very nascent stage and if you have a brilliant idea, I would really encourage people to get into some sort of accelerator programs, a very top end, sort of acceleration programs, like Y Combinator and stuff has really brought out some brilliant companies, not only with the funding opportunities that they provide, but also the assistance and the mentorship that they provide throughout the process. So that's another option. Obviously, raising funds through debt is one option, which we will cover in detail. There are also options available with government schemes, subsidies, grants and rebates, stuff like that. There's definitely funding available through, schemes through Niti Aayog. There are funding available especially if people are joining us from Gujarat. There is also a regional scheme for startups for Gujarat. So there is a scheme called SSIP, which is Student Startup Innovation Program, which enables the students to prototype their uh, startups or the ideas and gets 2 lakh rupees of funding just to kind of bring that to some sort of seriousness. And it is not a loan, it is a grant. The same way, if you mature a little bit more, then there is a 10 plus 10, 20 lakh rupees of grant that is available from the government, as a startup innovation program. So there are definitely a lot of different options that you can think through government. There are also loans that are available at cheaper rates. For example, mudra loans are one of the prominent examples and stuff. And then finally, you can look into options of um, a lot of corporate driven programs. So a lot of corporates also run innovation challenges and stuff. So if you think that your company fits into that category, I know that a lot of companies like Yes Bank and whatnot, they had sort of fintech challenges. You would, if you are registered on a Startup India portal, then every now and then you would find a lot of partner sponsored challenges that come on those portals, uh, wherein banks, wherein um, defense companies and a lot of other companies, they want to drive a lot of innovation out of startups, and that is why they run all these programs. And so it might be a good opportunity to explore those sort of programs, and if you really fit in, I think it also brings a lot of strategic benefits for you in terms of kind of attaching yourself with a bigger company and really tap into a readily available pool of customers over there. Um, so finally, we are covering. So these are the options that are available with you, but I think equity is one of the major ones, right? Whether it is through friends and family, a seed round, an angel round, Series A, Series B, VC back, whatever you want to call it. It simply boils down to you trade your equity against the money that you take, right? So definitely a lot of nuances of those and how to do it, and what kind of things should be there and stuff, and the term sheets and the negotiation part and all those things, which we will cover in the next chapters. But understanding this at a very high level, sort of an elevated view, is one thing that is for sure, that you part your ownership in the company to get this equity or to get this funds, right? But with the ownership, you also part some control on making decisions. May it be a day-to-day decisions, or may it be a very high-level decisions made at the board of directors. It depends on what is the involvement that the funder has in the deal, right? Definitely, because it comes against equity and there is no assurance or pledging of assets and stuff, it is deemed to be a little more riskier, at the same time a little more expensive way of raising funds. And when I say expensive, it is basically the expectation of ROI that any funder would have out of these sort of deals is going to be more than what you can get in a debt-based funding, which is probably available anywhere between 7.5 to 15% if it's unsecured um, loans, right? But obviously, all those things come at a firm commitment, versus this is something where if the company makes a profit, then they probably get their money back, otherwise they don't. So in that sense, they also have a higher expectation of ROI. Also, you would want to weigh, as we already discussed, what are the other things that these funders bring on board, right? And this is something very, very important, and that is why I'm really emphasizing on it. Right, a lot of times people take money as the only benchmark, but I think the idea of a startup is to get from point A to point B in terms of sales, traction, number of customers, whatever the key parameters are, in the least available time, that leads you to the next round of funds, higher valuations, higher sustenance, whatnot, right? And so it might not just be the money, but it is also the value that the funder brings in. When I say the value, that means the kind of mentorship that brings they bring on the board, the kind of industry connections that they bring in, the kind of access to already people who are their clients, and you already have an established chain of supply available with them, right? Those sort of things. So when you get to a deal where you are negotiating an equity based funding deal, you would want to keep these things in mind and see whether these are also the benefits that a particular funder kind of comes along with, right? Obviously you understand that there is no obligation to pay back in most of the cases. However, it also depends on how you structure your term sheet. Sometimes there are minimum commitments or whatnot, right? Or there could be clauses which would define it a little differently, but that's something that we can take up in the term sheet discussions. And finally, limitations on further round of funds is also a point that we would probably discuss in the term sheet. But at the same time, we have to make sure that um, if you take funding at this point of time, what are the restrictions that you're bringing on board with what you agree today, that is going to limit your scope to raise funds in future in any case, right? And then finally, I would leave you guys with some thought on getting yourself ready, for raising funds. So the first thing that you need is an elevator pitch. And an elevator pitch definitely comes along with a clarity on a vision and mission statement, right? What is the role that you have in this particular, in this whole world as a company, right? What do you want to achieve? What do you want to be in long term, and how are you going to get that done, right? Which is your vision and your mission, and which drafts your elevator pitch, right? Is if you have an absolute clarity and you can pass on your clarity to somebody in the first 45 seconds of your meeting, that means you have a lot better chance of closing that deal, right? And this doesn't only work in the funding deals, but it also works every single at every single stage in your life. May it be your personal relations, may it be your professional relations, may it be your sales deals, may it be your funding deals, right? If you bring so much of clarity in the first 45 seconds that the other person does not have any other way but to get impressed, um, it just solves for the 50% of the of what we want to achieve right there, right? Once we have done that, then your business plan and pitch deck becomes very, very important. That is why it needs a full session on that. But you have to be very clear about who are you, what is your team, what are you going to achieve, how are you going to achieve it, what are the finances that would be required to get there, right? So you don't want to be in a situation where you commit a lot of things but you don't have enough resources to actually achieve those commitments, right? Eventually, what is the competition, where do you stand in the competition? All those things get into your pitch deck. And understanding your current situation, so what you are today, and that primarily defines what is your ask. So if you know that you are a software making company but you are not Microsoft yet, then your ask is going to be as reasonable, and that also increases the chances of closing the deal. A lot of times what happens is people come with a lot of aspirations, right? And which is great, but at the same time they are not realistic, and they does not define what they are today, which creates their valuation or perception in the funder's mind as of today. So we need to be aspirational, we need to be a dreamer, but at the same time we need to be a realistic dreamer, right? um, then you need clarity on why are you the best amongst other 5 or 10 people. If you are working in an industry which you think is a complete monopoly, then probably that is not right, because right now the situation is so open that many a times you will find an alternative. So Uber cannot claim Ola only as an alternative, but also a normal rickshaw driver or a normal a bus driver who brings people from point A to point B is a competition. Now, how do you make yourself better? Is the app or is the offering, right? So you need to know what value addition do you bring? Is it the team? Is it the technology? Is it the services nuances, the product strength, the co-founder profile, current performance, your numbers, your sales, your clients? What is that? And try to highlight that in your pitch deck, right? You want people, especially your prospective funders, to think about you very high, and that is why you want to use those things that you really think is working in your favor today as a highlighter in the pitch deck, right? Then you need to have a clear financial projection, right? So every industry is a big industry. If you think about my industry, it is business professional services. The lakhs of CAs, company secretaries, chartered accountants, lawyers, tax practitioners. I can't claim that to be $1 billion industry that I'm going to win today, right? I have to break it down, and I have to break it down in the way that I think is what is achievable for me, right? So you have to make your projections in the way that are not just very optimistic, but at the same time, what is realistic for you to achieve in next 1 year, 2 year, 3 year, and clearly specify those. I think clarity and specific is terrific over here, right? So if you are very specific, you are going to build a lot of confidence for yourself. Then you have to define what is the use of funds that you're going to have, right? So assuming that you are asking for, let's say, 5 crore rupees, right? How are you going to use it? Are you going to build new products from there? Are you going to reach out to more clients? Are you going to use that in marketing? Are you going to use that in PR? Are you going to use that to hire fancy executives? What is going to be the usage of that? Every funder wants to hear how their funds are going to be utilized and be aligned on that thought process. Right? So these are some of the things that you would want to prepare beforehand, and then go to a funder. Right? Then obviously the KPIs of success, whether it is traction, whether it is profitabilities, it is top line, bottom line, number of customers, number of downloads, number of people reached. How do you define your business as a successful business, right? And you need to decide that, because you need to have that as a benchmark today, so that when you actually become successful, you can use those predetermined KPIs to measure your level of success, right? And finally, why only this particular investor? This is very, very important. A lot of times people are, and especially startups, are in desperation, right? Startups think that anything or anybody who gives me money is a good investor. And that is how we have seen a lot of startups also failing, because they could not take investment from the right people. And a lot of times it then creates frictions, and eventually pull back of funds or whatever. But this is one opportunity. So it is almost as good as finding your next co-founder, finding your next life partner. It is going to be as important. So when you reach out to a particular investor, have a lot of research. What kind of portfolio do they have? If I am a business professional services platform, are they a platform that provides a tax planning services, or a tax income tax filing digital platform or an app? If that is the case, I know that there are already thousands of people who can be strategically aligned to my business, just because we have a common founder or a common funder, right? At the same time, some investors are more sector specific, some investors are more sector agnostic. So your pitch should be tailored to everyone, right? If I go to somebody who just invests in fintech, I would have my pitch deck highlighted a lot more about fintech and why I'm relevant in that play. Versus if somebody who is more sector agnostic, I would probably say that you have investment in renewable energies, you have investment in robotics, you have investment in these 5 fields, but you're lacking an investor or investment opportunity in fintech, and so I will complete your portfolio, right? So your pitch should be very specific, and it should interest your investor. At the same time, you have to make a very conscious decision that this investor is a good investor for me, and he or she will, or as a fund, they will add value to my business. Just getting money is is probably only one half of the puzzle, and the other half of the puzzle is definitely your alignment with that particular investor, and how you can get in a long term relationship, taking the business ahead. So I think it becomes very important that you also start picking your investors in the way that you would pick your employees, right? And vice versa. Obviously, we are not devaluing anybody over here, but I think the startups should also start being very selective in terms of what kind of investment do they bring in. With that thought, I think I'll pass it on to Druman bhai, and if you guys have any questions, then definitely here to help. So you can keep adding that to the chat box, and we'll take it up. Thank you for having me.
Thanks, Shrijay. Thank you so much for all the insights that you've provided out here. Shrijay not only focused upon different funding options available, but he also talked about what ideally would suit a particular startup or a business in different particular stages, and what nitty-gritties should a startup founder take care of while looking for an external funding. Now, I would like to extend my hand to Mr. Druman Patel and request him to go ahead with his presentation before we take up the fireside chat. Druman bhai, please go ahead.
Thank you, Faraz. Shrijay bhai, thank you for that wonderful presentation. I think that gives us like essentially the ABC of equity funding and why equity and how to essentially go about it. So I'm just gonna go ahead and share my screen. So just confirm that you can see it. Can you see my screen?
Yes.
Yes, your screen is quite visible.
Okay. So first of all, before I begin with debt financing and structuring, I'd just like to spend a few minutes to talk about the environment as a whole right now. So first of all, I hope all of you and your families are doing well and are safe during this time. And I hope everyone is maintaining social distancing and all these new words that we are learning day in, day out. So I hope everyone is doing well. Secondly, to all the startups who are here, I just like to say one thing. I'm sure you are very stressed about how your next couple of days are going to go. How are you going to survive for the next couple of weeks, couple of months? One thing for you to know is very important, that you are not the only ones who are facing these issues. Everyone from pin to a plane. So from a trader in paint to Asian Paints, all of them are thinking about the same things. All of them are under pressure, and resilience is the most important word in this time, because the fast thinking, the quick steps that we take to ensure our survival is going to be of the key importance in this time. So now just diving into what we are, who we are, and today's topic. So I am a partner in Manubhai and Shah LLP. We were incorporated in the 40s. We have been here for a very long time. Essentially, we have been working with from small sole proprietors to the largest listed companies in the country, specifically expertising ourselves in virtual CFO services, fundraising, structuring of deals, structuring of M&A activities, and getting funds from across the globe. Today, I'm going to continue what Shrijay bhai had started in terms of ABC of fundraising, and I'm going to specifically talk about debt financing, then go towards structuring of companies. Just a very 20,000 feet view of this. We do not want to go into a lot of detail. That will be very specific to every startup, very specific to every company, that we'll have to sit one-to-one to actually go into those things. And then I'll just have a quick one slide about the best management practices that I think people should be aware of, because I think it is very, very important to understand that being an entrepreneur, it's like from peon to partner, you are everything. So it's quite important to understand a few best management practices that you should be having. So first, let us begin with debt financing, right? So first, what is debt financing? When a company borrows money to be paid back at a future date with interest is known as debt financing, and it is usually backed by an asset and a collateral. A company takes up a loan either to fund their day-to-day operations or to acquire assets or finance a long-term project. So I think we are all aware. I think we all know what this is, and there is no two ways about it. Everyone knows that we are trying to raise funds. This is a loan essentially that we are taking. This is the most traditional way of raising finance, and specifically for Gujarat, because Gujarat is known for taking the most amount of loans, since Gujaratis never want to give up their own capital. For years, I have been working with people, and they said, okay, I don't care, I'm going to take 100 crore loan, but you tell me to shell out 2% of my holding. I'm sorry, that's going to my children and their children after that. So Gujarat is specifically known for this. As far as the startups are concerned, in India specifically, most of the banks, they do not want to give you loans without assets as collateral. And even if they will give you loans without unsecured loans, the terms would usually be so unfavorable that you would probably want to go in for other means. So the way around it is essentially going to the government to get loans. You have the Ahmedabad University Incubator giving you grants and loans. And like Shrijay mentioned, you have a few of these schemes coming here that the central government and the state government has to help you out. So this is essentially what debt financing is, right? Taking a loan. Now, why would you consider debt financing over equity financing? So the biggest advantage of debt financing is leverage, where the overall return on investment by the owner increases as the cost of debt is actually an allowable deduction under the income tax law. This cannot be done in an equity investment since you divest your share within the enterprise. So what happens? You still get the funds and you still have a means to actually grow your enterprise and to grow your enterprise value without actually divesting your shares. Of course, it has its pros and cons. There's no doubt that sometimes equity investments are way to go. But with every case, there's different pros and cons. You always have to weigh out your options and then go in and make that decision that what is the type of funding that you want to go through. But debt finance is essentially the traditional way, and we'll go ahead and talk about the different kinds of debt financing that any particular startup, or I would say even small and medium-sized businesses can actually think of. Let's see the different means. Deposits from friends and relatives. I think this is the one thing that even for an equity investment, this is the first thing that we think of. That okay, I want to start up a business, and I want money from my friends and relatives, and to kind of get a seed fund going, right? With that, it essentially there is a very small or a very hazed out line between in doing business and in mixing business with friends and relatives, is because you do not want to cross that line to break those bonds that you have, right? So for every deposit that you take from friends or relatives, your relation to them is probably more important than the money that they're putting in. So the most important thing I think in this case is you ensure that you have strong loan agreements. Do not mix business and family, and repay these loans as if you are repaying to a bank, right? You need a clarity of thought. I am sure you will have your kaka or mama or masa come to you and say, okay, here's an X amount of money. Do not need to repay. You repay me when you can. That the whole emotion out of that, you need to remove that. You need to get out of that emotion and ensure that you have things on paper and you ensure that you stick to them, because you do not want to separate. You want to separate your business and pleasure, and this is the only way to do it. Then venture debt. So all of us have heard about venture capital. All of us have heard about investment. All of us have heard about everything. You have Gujarat Venture Finance investing into the companies, and you have a lot of capital companies doing a lot of things. So what is venture debt? So essentially, it's a venture debt fund. Venture debt funding is a type of debt funding which is tailored for equity-backed businesses that do not have the cash flow or assets required for a traditional debt funding. So how is it different? Sometimes venture debt will not require to have assets backed. Essentially, this kind of funding tends to be structured as a combination of limited equity investment and a loan. So what it'll be something like a convertible note, right? It blurs the lines where you are getting a loan, but the repayment is in the amount of shares that you're going to give up in a year, in 2 years, in 3 years from now. And usually the term for such loans will be about 3 years, along with warrants for stock within the company. In India, warrants is not a common word; it's just shares, which is being used. Moving on to convertible notes. A lot of time what happens is investors do not want to give up equity right this point, right? And you still want to make it very lucrative for the investor to come to us, right? So how do you do that? And how do you still manage to save up cash flows and ensure that you still have the money? What do? You issue convertible notes. And how do convertible notes work? Is you say, take a piece of paper, that's an agreement, and you say that, okay, I am borrowing 1 crore rupees at an interest of 8%, right? And at the end of the tenure, for the amount of repayment that needs to be done, you issue shares at the value at which the convertible notes are being issued. So what happens? Investor is very happy that at the time of repayment, they have the shares at a value which is way under what the startup is valued at that time, and they get a 2x, 3x, 5x return as soon as the first round of funding comes in. So a lot of people tend to go into convertible notes. Unfortunately, if the startup actually does not blow up, actually does not do well, then this is actually just a loan, and they'll have to pay up using hard cash. So of course, every type of financing, there is some nitty-gritties that you need to take care of, and this is just one of them from convertible notes. Then you have NBFC and bank debt. This is your traditional lending. You go to a bank, you say that, okay, I have this property, or I have stock, or I have debtors that I'm mortgaging, and you get a loan. It's usually a working capital loan or a term loan or whatever the case may be. I'm sure you are more of experts on this than I am. Another type of loan is essentially external commercial borrowings, right? What it means is that's just a foreign loan. So now what is happening is you have a lot of NRIs, you have a lot of family offices across the globe where people have the funds to invest. What happens is when some kind of a product is not very popular in India, but it is a tech-based product and it can be sold worldwide, the startup might not be able to raise funds within India. This is the option that comes in, where you have family offices in if it is a tech enterprise, then Israelis are very, very keen on investing. You have America. We have a lot of investors who are keen on investing money in startups in India because they are essentially selling back in the US. And term loans, it's essentially like a term loan, but it's just coming from a different source. So not a lot of people are thinking about these kind of loans, only because they feel that oh, why do I need to worry about foreign exchange and how I'm going to deal with that and all of those things. Essentially, it's very easy if you can actually structure it properly, and which is why you have experts to do this for you. A lot of companies also issue debentures. Debentures is essentially something like what a convertible note is. It's just a different kind of a security. A debenture is a security, and a lot of financiers, they prefer buying debentures which are either sold at X or 2X price. They are bought back by the company either at 2X price when there's a next round of funding or something. So there's a mix between convertible notes and again issue of debentures. And the last is preference shares. So this is in between equity funding and in between debt funding, where you can call it like a quasi-equity kind of a thing, where preference shares are nothing but shares that you are issuing to the company, which will have a fixed dividend that you will have to pay, or they can be converted. They have the option of converting into equity, I mean the regular equity at a future date. So preference shares is a middle way out if somebody cannot go into equity funding nor they can go into debt funding. This is just one of those options that they can take. So now let's go through each stages, right? Each stages of a startup, you have different people in different stages, and I think we have about 60 or 80 viewers here. and all of them are at different stages right now. So either you are on ideation, you have a revenue, but they are up to, you are like a small sized company, you are a medium or a large size company, or you are a well established startup where you don't require essentially cash flows from anyone else. You just require the growth. You just require money for growth, right? So let's go through one by one. If you are a startup who are at the ideation stage, often positive revenues and income generation is required before getting debt funding. So at this point, either going to the friends and family to raise debt where the repayment is favorable terms, or getting an equity based angel or a seed fund is your best bet. No banks will be ready to give you loans. You will not be able to raise a venture debt at this stage. Then going up to revenues up to let's say INR 25 crores. At this point, banks will be your cheapest form of financing, and specifically the local and regional banks that specialize in startup funding should be your first call, because as Shrijay mentioned, equity also comes at a cost and debt also comes at a cost. You need to weigh out what is the most advantageous for you at that particular stage. And then when you have revenues of over 25 crores, but you are still burning cash. So somebody like Uber at this point, who is worth what, 20-30 billion dollars, but they are still burning cash. What do you do, right? If you are burning cash, paying back interest is going to be quite expensive for you. You need to have a source of fund where you can pay at your convenience. So for breakout and established companies, growth capital is what your focus should be, wherein you have the revenues, but you also have that capital to kind of make the growth, make the leap, and ensure that you are earning enough to pay back what you have taken. And then you are an established startup. Again, an established startup, you just call yourself a startup, but then you are just an SME or like an MSME company, where a traditional commercial loan or a venture debt will be worth thinking of. And specifically venture debt, if you are trying to raise equity, specifically because they can be converted into equity at a later stage. So for every kind of, or every stage that your company in, you will have to sit and think about what is the best way to go. Let's venture a little bit on structuring, right? And why it is very important when we are talking about raising capital, whether debt, whether equity, doesn't matter. Structuring is essentially a key. Number one, shareholding pattern. It is basically the number of outstanding shares that are held by each shareholder. It is very, very important at this stage, because the decision of dilution, who is going to dilute what, is somebody getting an exit at this stage, is somebody new entering at this stage, what kind of a pattern that will be there. That's essentially what a shareholding pattern is. So for an equity raise, it is going to be very, very important that you have a shareholding pattern in place and you have a plan of how things are going to go when you have the term sheet in your hand, when you are out of the term sheet, when the deal is actually in place. So essentially structuring is applicable whether it is equity, whether it is debt, any kind of financing that is being done. Talking about the corporate structure, it is very important to understand what kind of a structure you are from, right? Whether you are an LLP, whether you are a private limited company, a proprietorship. To start with an LLP or a proprietorship, they are very, very easy to maintain. There is no compliances that you need to take care of. Money coming in and out of your own bank account with the company is with the LLP or a proprietorship is very, very easy. However, when you go to investors, they will actually frown upon investing in an LLP because that's not a very corporatized structure. It's very, very important to ensure that you know what kind of a corporate structure you are going into. Private limited company is very important when you actually have any kind of fundraising or a debt raising that you are going to do. Term sheets. The minute there is a term sheet on your hands, any startup will be on cloud 9. But what is very, very important to understand is that the term sheet is usually just the beginning of any deal. This is where the real mistakes are made. You are thinking that you have all the capital in the world now, and that's it. You are going to be a unicorn in the next couple of months. No, it is very, very important, and it is very, very crucial that we ensure that every clause on the term sheet has been carefully looked at, because you need to ensure where you are going, what are you stepping into, right? It's unknown waters. Like Shrijay mentioned, you have to ensure what kind of an investor is coming on board. What are the conditions that they have for you to work essentially as a startup? Are they taking control of your company? Are they letting you operate it the way you want it to operate? Which is why it becomes very, very important as a startup owner to understand that when you get a term sheet, you just don't sign it. You ensure you take your time, you have your experts, and you get into the nitty-gritties of each term sheet. And last but not the least, valuations. Now, there will be people who will tell me that what does structuring has to do with valuations, and that this is probably not the best place where I've put valuation as a point. But it is imperative to understand that the way you are structured will actually tell you what your enterprise value is. So valuation is actually the value of your startup at a particular moment in time. So let's say if Uber was valued at $20 billion on 31st March 2020, then the value of Uber on 1st April 2020 might not be $20 billion. You have your newspapers telling that, oh, Uber is valued at $20 billion. It is blowing up everywhere to say that it is valued at $20 billion. And in fact, I'll talk about recently, Vista Equity Partners, they invested in Jio. I think today the deal was announced, where Vista took a 2.32% stake in Jio at, I think, around about 11,300 crores, which takes the value up to some unimaginable, unheard of levels. But that doesn't mean that tomorrow morning Jio has the same value or the same enterprise value as they had when Vista Partners invested. So this is very important. Everyone believes that Jeff Bezos is worth $160 billion. He was probably not worth that a week ago or right before coronavirus struck us. So structuring, if you have a private limited and a B private limited and you hold 50% in each, your enterprise value as a whole will be divided into half. On the other hand, if B is a subsidiary of A, your value is doubled. So it becomes very important to know what kind of a structuring arrangement that you have to ensure what value you want to build, right? The value is built on the basis of the company's past performance and the future outlook and forecast with whatever relevant assumptions that need to be made. So it is very, very important for us to actually dig deep and see what is the best way to have your structure in place. So management practices, right? What are the best management practices that a startup can actually have to ensure what they are doing is the best, right? Number one, and probably this is the most important, is take the help of experts. You have fundraising experts, you have virtual CFOs, you have people like Shrijay who take care of all your needs in terms of your company formation and your accounting. You have accountants, you have lawyers, you have commercial rights people, you have intellectual property lawyers, and you have valuation experts. Experts are going to be a key pillar in the success of a startup. You are the master of your own product, but there are people who can take care of the rest. So it is very, very important to have the help of experts. Experts are here to help you for everything else. Leave it to them to help you navigate through the technicalities of running a business. Valuation experts can help you make day-to-day decisions to ensure that your enterprise value goes up in the future. Accountants can help you with a more tax-efficient structure on the investor side, so then your company is more investment friendly and it is more attractive to essentially the investors. As Shrijay said, take help of your accelerators, startup incubation centers, etc. They are here to help you. You have your university startup incubation centers. You have PDPU doing it, Gujarat University doing it. You have DevX doing this. You have all the mentorship that you need. You have a place to work. You have a co-working space. Use these centers essentially to help you grow. And last but not the least, go to your family. Who better to support you than the people who love you, especially when they have been in the business world for a long time. We as Gujaratis, we have this knack that all of our parents, you have your family, everyone's in some kind of a business. There is something that they are buying and there's something that they're selling, whether it is services, whether it is products, whether it is manufacturing, anything. They have been in the business world for a long time. You will get a lot of insights and ideas from them, and some of which you will never have even thought of. So it is very important, being a startup entrepreneur, you have to learn a little bit of everything. And as a startup entrepreneur, you have to be a jack of all trades. So management practices, people are here to help you. Take the help of experts. And honestly, if you reason it out with them, if you talk to them, you always feel that, okay, going to an expert is going to be very expensive. Honestly, it's not. Just reach out to people, just reach out to accelerators. Usually accelerators have tie-ups, and through those tie-ups, you get great advice at a very cheap cost, right? So try and make such connections, build your network, and that is how you are going to take your startup to the next level. You're going to go to the unicorn stage. So again, thank you Faraz, thank you DevX for this opportunity, honestly. And I think during this time, I think this is the only way to reach out and be in communication with the stakeholders, be in communication with the startups. And this is a great platform for all of us to be connected. So I now give this to Faraz and to, I think, essentially take it to the question answer round of our session. Thank you.
Manubhai, thank you so much for all the insightful talks that you've done out here. Previously, I mean, taking our attendees from understanding that debt financing is not just about raising money through some sort of loan, but various available options for the startups and businesses out here as to how they can raise money for themselves, raise funds for themselves using the debt financing model. Now I'm trying to put up different guys who have asked different questions as to what their problems are. And I would quickly put you through with Shaurya Chauhan. Shaurya, we have unmuted your mic. Could you please share your question with our panelists, please?
Yeah, sure. Hi, thank you so much. I have this question that do we have any pre and post money valuation at the seed round? And if yes, how do we calculate specifically the pre-money valuation?
So, all right. So Shaurya, thanks for asking the question. So pre-money valuation is probably the most important thing that kind of matters in the deal, right? There are several ways of calculating valuation. May it be the intrinsic value, may it be the future cash flows discounted, by certain expected rate of return. May that be evaluating competitors' valuation. So if you would actually think about, different sort of valuation, there are probably n number of techniques that are available. A lot of different VC firms have come up of their own valuation methods as well. Like a lot of prominent VC firms use a checklist method wherein they have their own customized checklist, and every item checked on the list gets certain point, which kind of becomes a factor of valuation. So a number of ways, right? Let me ask you this: if you have this apple in your hand and you would want to value the apple, I would probably value as 1 rupee, you would probably value as 2 rupees, depending on how hungry you are for that, right? And it similarly works in a startup valuation, wherein it is more of a demand and supply and the interest that the funder has, right? So if you are reaching out to the right kind of funding company or VC or angel who is desperate to get into this deal, you might be able to fetch a lot better valuation than in a position where you are the one who is in more desperation. So a lot of startups valuation really are not a lot of only science, but it also involves a lot of art of negotiation. Apart from that, talking of pre and post money valuations, I think post money valuations in most senses is the valuation that you would value your company at right after the deal gets done, right? And so let's say you are pre money valuation, $500,000, you raise probably another $50,000. Your post money valuation in a simple mathematical way becomes $500,000 plus $50,000, right? So there is not a lot of sort of importance that I want to give at this point of time for pre and post money valuations. Obviously, it is going to impact your next funding rounds, the other stakeholders that are involved in it, the amount of new shares that you issue, and so on and so forth. But I think when you enter into a funding deal, what is more important is what do you value your company as of today, which is before the funding got into the company. And Druman, if you would want to add something to it.
I think that has been covered. That has been covered nicely. And see, essentially between this is pre and post money valuation is also a lot of marketing. Also, I would definitely say is because again, as I told you, the valuation that you go, if you have two valuation experts that you go to, valuation expert A will give you a different set of valuation and B would get a different set of valuation. What is the most important is that what the investors in the investors' eye, what is the more reasonable valuation? So you can be very, very aggressive in terms of the assumptions that you make and get a valuation which is worth billions. And then you can be very, very regressive in terms of the assumptions that you make and you will have a very small valuation. But the balance in between this is where we need to strike. And that is where the investor and the investee communication lines are very important. The people in between these stages, the experts talking on the both sides are very, very important. So when it comes to pre-money valuation, yes, it is, of course, it is done also on the seed stage. You have your assumptions that you have your key assumptions, and then you have your services or products, and then you forecast what you're going to do over the next 2 years, 3 years to get your current value.
Okay, thanks. And just one more question. Second, my last question. Is there any size for the seed round? Let's suppose if I'm looking for 2 million or 3 million of USD for the seed round. So is there any specific size that if my business is heavy asset business and I need that money to purchase and to sustain for at least 1 year, I'm looking to target 1 year. So is there any specific size for seed round, or I can go up to 2 or 3 million? Is that valid to go?
I think it is absolutely valid. I mean, a lot of seed stage fundings happen anyways at $1 million plus sort of funding. If you are raising a friends and family round, or if you are raising like a very very seed stage angel round, probably it might be a little difficult to get that money, but it absolutely depends on the idea that you have, the traction that you have, the product that you already have there or in prototype, the novelty of it. If you are let's say building another SpaceX, if you are really in a rocket science, right, a $1 million seed round is going to take you nowhere, right? Yeah. So it really depends on what your business demands to grow. Typically what I would want to put out is, with every round you should at least secure a sustenance for your company for at least next 1.5 to 2.5 years. That should ideally be your goal. You don't want to be in a situation where you are raising funds every 6 months. Yeah. If the company grows really well and you need that, that's more power to you. But if you would ask me, ideally I would want for at least next 1.5 years of sustenance when I'm getting into a serious round of funding. So that should ideally be kind of the ballpark or benchmark.
Thank you.
Shrijay, to add up to this, I would like you to share your experience working with different startup founders. Usually the first round of funding is very close to everyone's heart. So, what kind of mistakes do you see the startup founders make initially, and the mistakes that would cost them a larger chunk later on?
There are n number of things that we have come across. I think I'll talk about two or three that either I have personally made or something that I really feel very prominent. First thing is always undervaluing the value of the co-founder. I think it is very important that everybody gets that very clear, that there is only very limited things that you can do on your own. You need a team to deliver, right? When you talk about something that you are doing on your own, either you are a consultant or you are a hobby business. You are nothing beyond that. When you say that you want to become a company, you have to have a team in place, and the team is typically people, right? So you have to start valuing your people. May that be through issuing ESOPs and get their vested interest, in the business for key employees. May that be getting a co-founder who actually complements your skill set, right? So you have skill set A and your co-founder has skill set B, and A plus B becomes a very comprehensive solution for the industry, right? So it attracts a lot of investment in that sense as well, is when the co-founder duo is a magical duo, right? So that's one thing that I've learned, is a lot of people think that I don't want to part my equity and I don't want to get a co-founder. I really have my reservations on that. The second thing is again, it is related to the equity, is people value themselves a lot higher in terms of aspirational value, and they don't raise funding at the right point of time, right? A lot of times opportunity has a very short window that it opens up for everybody, right? And at that point of time, the right decision that you make is going to make or break your story. And so it is very important to accept right kind of funding at right time to be able to hit the scale that you would want to hit. A lot of times people think that, nahi, abhi, if I dilute right now, I have to probably part a lot of equity. But the opportunity cost that I was talking about in the presentation is a lot higher, and it will remain with you as a burden for your lifelong. That you would think ki us baar kar diya hota, so the 70% that I would have held upon would have valued a lot different than what I am right now, right? So I think those are the two things that are there. The third thing, definitely, I keep adding more things. But the third thing is, be serious about entrepreneurship. It is not a fashion statement. And it might come very harsh to a lot of people, but what I've understood over the last 5 years of being in this trade is a lot of people take this as a fashion statement when they are especially when they are out of the college, right? Owning a startup in the college is so in for a lot of people that the fatality and the mortality of that is so high, and it hurts. It just does not hurt the entrepreneur, but also hurts the ecosystem as a general, right? And so I'm not against people starting companies in their initial years of careers, but at the same time, I would advise everybody to take that as a very informed decision. It is not for fun. When you start a company, you have employees, and so you inherit a trusteeship of everybody who is associated with you. And so it is a big responsibility. And as Spider-Man would have told, bigger power comes along with bigger responsibilities. I think it is time for everybody to think, ponder upon that and see what are the implications that we have of being an entrepreneur in general. So I think these are the three things that really kind of has remained with me in terms of startup learnings. Yeah.
I can actually add, there's two more things that we as a firm have seen a lot of times. And when I say it, Shrijay is going to say, oh, I missed just saying that, but that's going to happen. See, when it comes to the first stage of funding, people get very excited. Okay, so they have a term sheet in their hand and they say, okay, now I'm worth 5 crore rupees tomorrow morning. Okay, because I have this term sheet in my hand. But what they don't realize is how they're going to scale to that level, right? You have a pitch deck which says, okay, out of the 5 crores I get, 1 crore is going to be marketing, 1 crore is going to be an office space that I'll get, and whatever, I'll hire so and so people. There's no plan. This is just an idea which is pitched to the investor loves it, they've invested. So after getting that money, see, I'm talking about an issue that comes in right the moment you have that money. And then people are saying, okay, I have this money, and they start spending it all everywhere, and then they don't exactly know how they're going about it. So this is what causes a lot of startups, if you see the mortality analysis of startups, the scalability related issues, if you see, you will have a number of startups. I think about 50% of, I think even NASSCOM said that 50% of startups die out because of scalability related issues. And it is very, very important to sit down and plan when you have the money, when you are actually on the top of the world, when you have somebody investing in you, you have to put your feet on the ground and think about how am I going to take this to the next level, which a lot of founders, a lot of startup entrepreneurs are not doing, right? So people feel that they are entrepreneurs, like Shrijay said, it's a fashion statement. I'm worth 5 crores, 50 crores, and nothing can go wrong. But that is exactly when everything goes wrong. So that is one. And second is when the top management or the two co-founders, like Shrijay said, co-founders are very, very important, where they actually have synergies between each other, right? 1 + 1 should equal to 3. Only then that 1 and 1 should be co-founders. What happens is when they actually get the money, co-founder number 1 wants to go north, co-founder number 2 wants to go south, and there's a feud, and then the whole startup breaks apart. So these are the 2 key points that every startup need to plan. This is not about your ego. This is not about the co-founder's ego that this is me, this is mine. You are not your company, you are a part of your company. That is a key consideration that all startups should have in mind.
Seriously, brutally honest words from our panelist out here. Next, I would like to put up Mr. Ashutosh Soni online. Ashutosh, I'm unable to unmute you. Could you please unmute yourself?
Hi.
Yeah, Ashutosh, please go ahead with your question.
Yeah. So my question was are there any technicalities for equity? Is it entirely a negotiation, or you have some system behind it? Like, how do you give equity to the investors?
As in, how do you process that in terms of share transfer or issuing new shares, something like that, or how do you value? Okay, processing. Yeah, definitely. There has to be, compliance work. There has to be. So the entire process, how that functions is, let's say you and me are 2 parties and we agree upon certain valuation, right? We will draft a term sheet. Term sheet is a non-negotiable or it is a non-binding document, right? So it is non-enforceable document, but it brings all the key points on a paper that we both agree upon, right? So let's say I agree that I'm going to do this. You agree that I'm going to give you so much of money. This is going to be the roles and responsibility. This is how I'm going to receive the money, the trenches, the equity vesting, those sort of things. They all make part of the term sheet, right? Once the term sheet is there and as parties, we all agree to that, we go ahead and do a shareholding agreement, which is a binding agreement. So shareholding agreement typically talks about all the nuances in much more detail, your arbitration clause, your non-compete, how we are going to engage as 2 different individuals in this business, the funding nuances, any sort of reservation in terms of, if at all this happens or does not happen in the next tranche of funding does not come or comes, and those sort of. So they all are, make it to part of the shareholder agreement. And then you exercise that agreement, right? So then you have share transfer, and that becomes a matter of company secretarial work. So either you issue new shares or you transfer your existing shares and transfer the ownership. it also involves a taxation part of it. So if you own the shares and you transfer those shares to me, then obviously you have certain value that you acquired the shares at, and now you are transferring those shares hopefully at X plus Y value. Then there is a capital gain involved. If you are issuing new share, then your authorized share capital inflates in the company, right? Or the paid up capital inflates in the company, and so you need to do company secretarial work or the compliance work over that. So all those are more of the technicalities, but I think the technicalities are best to be left to the professional that you trust, right? Every time I want to build a rocket, I don't need to understand rocket engineering. Sometimes it is best left to the scientists, right? So I think if you are going through that process, I would highly recommend getting in touch with somebody who already understands that and works in your favor.
Okay. Thank you so much.
Great.
Yep.
Shrijay will have quick 2-3 questions. I'll put forward Niharika Sharma. She seems to be a budding entrepreneur. Niharika, please go ahead with your question.
Hello.
Hi,
Yes,
Niharika.
Niharika, we can hear you.
Hi.
Yes. So my question was, is it really wise to start off as an LLP or a proprietorship if it comes to a startup for a clothing brand, totally e-commerce, with funding mostly coming from friends and relatives? Also might consider bank loans. Investments and operating partners shall be needed too. What do you think would be better for me, like layman term wise?
Sure. Druman bhai, you wanna take it? Or
Druman bhai, do you want to take it? I guess we have a stuck video for Druman bhai. Shrijay, please go ahead with it.
okay, sure. All right, I'll take it. So any formation of the business, right? It really depends on several factors. One of them being, what is the risk associated in that? So that is one of the very important factor. In fact, is if you assess that your business risk is very high, which in some e-commerce businesses it is definitely the case, and you think that risk should not come to your personal assets. In very layman language, if धंधा नहीं चलेगा तो घर नहीं बिकना चाहिए. So in that case, you have limited options available, which is either an LLP or a private limited company. If you are a sole owner, then you can go for an OPC, or if you are with partners, and you can, or with other people, you can go with a regular private limited company. But that is one of the most determining factor. Is whether you want to get a limited liability protection or not. Apart from that, definitely there are other factors. For example, when you are trying to raise debt, a lot of times banks are more favorable to a structured form of business versus a proprietorship, right? Because obviously it is under a better compliance net and whatnot. So those sort of things are there. Your perpetual existence, or your existence with or existence of the business apart from an individual's existence, if that matters, and the brand identity should be carried forward that way, then an LLP or a private limited company could be a better sort options. If you want to make employees part of the business and issue ESOP, then private limited company becomes your only option. So there are probably 10 different questions that you would want to ask yourself.
Yeah.
And based on the answers that you get, you want to pick a business formation type. So a lot of people come with predetermined mindset that I want to register in a private limited company. But the question is, why do you want to do that? Why? Because obviously it comes with a limited liability, also comes with bigger expenses. It has to be audited irrespective of the volume of business that you do and whatnot, right? So you really have to answer that. The other question, the other feedback would be, if you want to be registered as a Startup India under Startup India DIPP program, then private limited, LLP, or a registered partnership are the only 3 options available. So you can't be a proprietorship in that case. So there is a checklist, and one of the resources that I could actually guide you to is, if you go to LegalViz's website, and go to any of the private limited company or an LLP page and scroll down, there is actually a comparison chart that we have put out there. And it might solve for a lot of questions that you would have in terms of in which situation, what business formation structure is more favorable compared to not. And based on, what is your most perceived value, you should opt for an option. So those are my 2 cents. And I think Druman Bhai can add value to that.
Just one last thing to add to this. Saying that when you are actually starting out and you know that you do not want investors for a little while, let's say 2, 3 or 4 years, you are okay and you will be able to survive. I think at that stage, an LLP I would not prefer you to open up a sole proprietorship, because then that just causes issues like what Shrijay Bhai just mentioned, that you should be registered as a startup under the DIPP program and things like that. So you would rather go to an LLP, because the compliances that you do are 25% of what you would do in a private limited company. And at a stage when you are really kind of trying to grow your product, you want to concentrate actually on growing the product and not worrying about the compliances. And coming to a later stage, it is as easy to just convert an LLP into a private limited company, and any chartered accountant will be able to do that for you. So when that stage comes, you might want to do that, but you can just as easily start up with an LLP.
Thank you so much. That was really helpful.
Great. So we have next question from Ashish. This is one last question that we'll be taking up. Ashish, please go ahead with the question.
Yeah, hi. Thank you. Just one, thing. Do you think in this current scenario, it's a good time for a startup to try and raise funds? That is one. And mainly, in another thing is, when the future of the existing businesses itself is in question in this scenario, do you think any of the VCs or banks or anybody would be ready to invest in a startup?
So if I can start with answering this question, there's 2 things. So I'll go to question number 2 first, where will people be interested in making these investments, and banks and all of that. I'll give you an example. So a microfinance company based out of Delhi just raised $5.7 million, right? So now, why did they get that investment, and what was the story behind it? See, now what has happened is, because of the COVID-19 coming in, you have your sectors which are very, very favorable. You know that they are going to grow. And you have those sectors where you have no idea what is going to happen. Hospitality, retail, public transport, you just don't know how their future is going to be. So what is happening is, a lot of investors, a lot of VCs, a lot of private equity firms, they are trying to diversify their portfolio. So if there is a sector-specific, hospitality sector-specific private equity firm, they would now want to share. They would want to make their investment wider. They would want to go sector agnostic, only because they know that there will be losses in one particular sector. That is why they'll go to the other. So essentially, it depends on exactly what kind of a business it is. You have analytics firms based out of southern India. You have analytics firms based out of Hyderabad and Bangalore who work for, let's say, Netflix or Hotstar, who tell them, oh, what viewership is important. You will have investments going to such companies. Or you will have companies like virtual CFOs or companies like LegalViz, for that matter, when now people will not want to have accountants within their business, and they'll say, okay, if to hire an accountant, it takes 10 lakh rupees. If I can just hire LegalViz to do it for me for 7.5, why not just go there? So it will be very, very specific to each sector of how this happens, but I am definitely sure that the demand will not go away.
Shrijay, would you want to add to this?
And I think the only thing that I would want to add is it does not matter, or it matters less how many investments happen. Your company only needs one, right? And so even though it is going to be tough, we all know that, right? I think if we can work on ourselves to become a better portfolio company, I think it is going to be more important to do that than worrying about whether there are 5 or 50 funders out there, because all you need is you need one,
Exactly.
right? So I would probably spare more time in thinking how I make my pitch deck, my value proposition better, than thinking about whether there are 5 or 50 out there to fund me. So just a little bit of more optimism, I guess, that adds to the conversation. But times are tough. Let's definitely face that as well.
That was very helpful. Thank you.
Thank you.
Great. Thank you so much, our dear panelist. Just want to share an insight with you that we had almost 60% of our attendees from Gujarat and more so from Ahmedabad. But we also saw a large participation from the participants coming from Karnataka as well as Maharashtra. Devex is extremely happy to share that a speed dating session will be organized for the participants of the event. We will shortly share an email with you carrying a feedback form. Within the feedback form, you'll have an option to register yourself and select yourself by answering yes for a speed dating session. Our panelist would get in touch with you. It would be a closed door 1-to-1 10-minute session for each of the participants registering out there, and they would help you solve your fundraising query. Now, on behalf of Devex, I would like to thank all our partners and participants for attending this webinar, and more so our esteemed panelists for providing us with such insights and guidance. We look forward to host you at the second part of this webinar that would be largely focusing upon the essentials of a pitch deck and more so deep diving into the term sheet. Thank you so much. We'll see you guys next week, same time, 4 to 5 p.m. for the second part of the ABC of fundraising. Thank you all. Thank you so much.
Thanks so much for having us.
Thank you.
Thank you, guys.